Leadership Forum on Real Estate Investment and Finance, titled Opportunities Amid Crisis, Breaking the Real Estate Investment Dilemma. We have a great lineup of expert speakers and panelists who are going to shed light on one of the most burning topics of the sector today, investments and finance in built environment. Even before the COVID pandemic hit, the Indian real estate sector had been reeling under the effects of lack of access to low cost capital. Well, actually, the capital itself. There were so many dynamics playing out in the market, with the government and policymakers doing all they could to provide the sector the necessary stimulus it needed to continue being an engine of growth. So while some may say that the pandemic brought the sector to its knees to so to speak, others may just call it the silver lining, and it seems to be proving right for many of them given the current trends, opening a multitude of opportunities to be looked at, right from stressed assets across asset classes to new micro markets and regions. There are avenues for investors to get the returns they seek. Through the course of the discussions that follow as part of this forum, I'm certain we will have some very unique insights on where the real estate investment market currently stands and what is the potential going forward given the recent uptick in sales across asset classes. I would also like to take the opportunity of thanking our presenting partner, Intellian Offices by Tata Realty, as well as our knowledge partner for this event, JLL India, for supporting us to continue to engage the sector on platforms where we bring unique insights into the market to the forefront, which I'm certain will do today as well, given the lineup of elite speakers and panelists we have. So with this, and without much further ado, I would now like to invite Mr. Sanjay Dutt FRICS, MD and CEO, Tata Realty and Infrastructure Limited, Tata Housing Development Company, and Chairman, South Asia Board RICS, to kindly make his keynote address, please.
Thank you very much, Nimish, and thank you very much, Nimish and Ramesh, both of you together, for organizing this event. And what a lineup, Nimish, you have arranged for this session. So without further delay, I'm going to put a short presentation, one which will talk about Tata Realty. Tata Realty has remained somewhat understated for a while, and it was important for us to kind of showcase our portfolio. So I'm going to do that very quickly. Just bear with me. I'm making sure that yes. Good. So, and the second section of my presentation would be all about the markets, just to help our panelists take away some data points, and that I'm sure will make the whole session very interesting. So right here, a very quick summary of Tata real estate journey in India. Over 35 years in the country, we have a very large portfolio of residential and a growing portfolio of commercial. We are present across 15 cities. We have 42 projects and completed nearly 18.3 in residential and roughly about 18 to 15 million square feet self-development and also build to suit for TCS under commercial. We have income generating portfolio of 6.2 million square feet under commercial and approximately 20 million or at various stages of development across 6 major cities. And we have some lineup of new projects which we are under contract, which will give us additional of 12 to 13 million square feet over and above. So pretty large presence. Increasingly, our strategy is to focus on 6 to 8 cities. So perhaps exit from tier 2 and tier 3 cities and focus and expand our portfolio and bring commercial over the years at a similar par as we see in residential. We've seen commercial, with unprecedented growth, and despite the various setbacks starting from global financial crisis, artificial intelligence, and more recently pandemic, we've seen that the macro fundamentals have kept this segment very strong, and as a result, we actually totally committed to this segment. And as a result, we've actually came out with a single Tata standard across the country for our commercial development. And this brand, our vision and mission is to create uh, a standard in the commercial real estate and be amongst the top 3 developers in the country, and also look at development from occupiers' perspective to ensure that we are purpose ready for all the changes that are happening in the market. And therefore, we are developing a modular, dynamic office spaces across the country. The 3 pillars that we are focusing on are basically making our building very intelligent and smart, creating communities to make sure that we have a very collaborative environment. Can we look at from engagement of employees perspective to ensure that we're able to reduce attrition, we are able to increase productivity? Can we come out with some technology and tools to ensure that we deliver value beyond just real estate? And how do we make ourselves dynamic and adaptive to ensure that we are working with the sector and industry and the changing needs of the occupiers? And I'm sure there would be some discussion around it today, given the current circumstances that we're going through. We felt that we create this brand across segments. So the top 2 talk about commercials. So left-hand side, Intellion Edge is commercial stand-alone suburban developments. And Intellion Prime is the CBD commercial development branding that we have come out with. The one at the bottom, Square and Park, basically talks about IT developments, a very unique branding, and Park obviously conveys a much larger developments. Most of our developments will house 50 to 60,000 employees or even more in these parks. Our presence is across the country. We are one of the few developers from West and North who have actually a presence in Gurgaon. And that basically a very simple strategy to ensure giving our occupiers a uniform standard and experience. So most of you know that we started our journey back in 2007 and 8 from Chennai, and it's a SEZ, and it's a benchmark in its own class. So nearly 6.2 million, and many of these coming up in future, which I will share shortly with you. Ramanujam Intellion Park is 4.5 million square feet. We're just setting up a 112 key service apartment, which will be opening by January and February. So complementing all the occupiers for their needs. Over 25 acres of development, very stabilized asset, and we've seen nearly 100% leasability and very high, retention of occupiers in this park. Likewise, we're creating another park in Gurgaon where we're likely to receive occupancy certificate of 2 of our buildings by this December, and it will be open for leasing. Again, 3.5 million square feet. Intellion Park, Navi Mumbai. This is a 47-acre development, 7 million square feet. We've just signed up build to suit for a data centers, and we have a speculative building to commence very soon. All of these developments will be gold, LEED, or platinum category developments. This is one of my favorite projects. It's a 192-acre mixed-use integrated township where we've carved out on the north side of the development nearly 50 acres for a 4.5 million square feet of commercial development. And right now we're entertaining a lot of RFPs there as well, besides having interesting mix of residential and other uses in this development. This, of course, has a direct connectivity from the airport road, so it's quite unique and perhaps the only project to have that access from the airport road. We have another beautiful property in the city, Yashwantpur. This is one of our Tata subsidiaries who owns the land, 12.95 acres and nearly 0.8 million square feet, a very horizontal development in a prime location. And this is something we're working on. Our plans is likely to be sanctioned and we're going to roll out very soon. I'm going to move very quickly. This is a commercial development. This is a real picture of Intellion Edge, nearly 1.6 million, of which 800,000 fully leased out, one of the building to a global tech and one to our India headquarters of airline and few BPOs, etc., including our own office in the same building. This is our asset which we purchased in Mumbai called IT4. We call it Intellion Square. This is in suburban development. 800,000 square feet, nearly 100% leased again. This is a small multi-level car park development which we have kept under our portfolio in Gurgaon. Small retail already leased out and few remaining places to go. This is a prime 5-acre CBD mixed-use development in Colombo, where we are actually now shaping the first commercial development, nearly 500,000 square feet. The second building on the right-hand side at the back, where we actually inviting build-to-suit and some pre-lease commitments, and many of our consultants actually engaging with our team. This would be really close to 2.5, 3 million square feet of mixed-use development. So in short, since we've kind of always remained understated, I thought it was useful for us to kind of convey that we bring on the table something that Tata as a brand stands for, which is trust and transparency, institutional ownership, and commitment to the end users. The Tata is known to be customer-centric, and therefore all our investments across our portfolio is beyond just the numbers. So we're making sure that we invest in creating something which is of value, not just for our investors and partners, but also to our occupiers. I will move on very quickly to now our next section of the discussion. This is about opportunities in post-COVID world, very relevant for our panel today for discussions. I will start with the commercial assets. If you look at the slides, the absorption has come down, which was expected, but many of us actually expected this to be a complete wash. Ramesh would support me. I believe after global financial crisis, the net absorption came down to the lowest of 19 million square feet. And who would have thought during COVID, despite the total disruption and occupiers working nearly 98%, 99% from home, would still be able to see the big picture and the growth and be able to commit 21 to 24 million square feet. So down from the last year's of 49 million square feet, but still commendable considering the current state of affairs and wait and watch by many companies and work from home. Simultaneously, I think the supply also has come down, largely because of construction coming to a complete halt and many developers thinking of not doing speculative, and therefore 60 million square feet, what was envisaged sometime in fourth quarter of calendar year last year, is now down to 34 million square feet. On the right-hand side, you will see some of the trends and current situation that is going on. So let me first bucketize occupiers. Occupiers are genuinely concerned about the safety, and therefore they're not returning very soon, except some of the occupiers are making it slightly more flexible, and therefore we will see a very normal and gradual return to normalcy. And perhaps work from home will continue for some more time. And of course, a lot would depend how things pan out going forward. The other aspect is, like you would expect, many occupiers making sure that they optimize their portfolio. If there was a kind of a hard options or future commitments, they're making sure that they don't do that, and therefore making sure there's financial discipline around this, because just generally every occupier is conscious. I would say beside the outsourcing, third-party outsourcing companies, even the captives are actually following the same line. But given the certain trends, I can clearly see tech companies still very strong in India, and therefore committing spaces. And some of the new RFPs that I've seen lately likely to indicate that they will commit another 4-5 million square feet, and therefore the captives perhaps will continue to grow even despite the challenges that we see. On the developer side, there is a complete wait and watch. We are making sure that we keep our parks functional. We follow the government guidelines of COVID. We are partnering with occupiers to ensure that we manage, should there be COVID cases, follow the government guidelines and sanitize the parks, etc., etc. So therefore, a lot of collaborative approach between developers and occupiers and the government, I would say, who across the states have done a wonderful job. A lot of investments continues to flow. That's the third bucket. So while there is a lot of consolidation, uh, there is clearly an interest from investors. And I think the fourth trend, of course, clearly is that the REITs have done well, and therefore few more REITs likely to hit in the market, and we'll discuss that in few seconds. Uh, One of the most powerful impact that I've seen that has, thrown a lasting impression on everybody is the engagement between the employers and the employees. There are a lot of concern about the health, safety, and well-being of workers, and I think corporates have really stepped up to ensure that they engage online, provide health facilities, medical facilities, because clearly the lives are disrupted. And in many cases, because of a lot of migrant workforce, uh, young workforce is not able to go back to their homes. They migrated from tier two cities. They're concerned about parents, et cetera, et cetera. So I believe the corporates have really stepped up and given that flexibility and looked after the employees. The work from home has already come a long way. And I think beside being able to adapt so quickly, a lot of companies have really rolled out various schemes to enable uh, employees to be able to do their work better. The third component is the embracing of technology, which we have discussed across various webinars, but clearly we can see a lot of capital being put to use to ensure that we are also future ready. And I know we have done it in Tata Realty, making use of these 9 months and rolled out various technology platforms and tools to ensure that we are able to arrest declining sales in our businesses and also make sure that we are responding to our customers and vendors and partners across. Uh, Also, just quickly highlighting on another powerful trend of data centers which has happened, and I think that's where Mumbai and Chennai and many other markets seeing a lot of commitment. And I have a slide on that towards the end of the session, which I'm sure the panelists will find it extremely interesting to deliberate. A very quick summary of REITs which we have seen. While the deals that we recently heard in Bangalore, some of them very large, up to $2 billion, going at around cap rates of 8%, the public markets are actually around 7.5 cap. So yields are still sub 8s overall, or likely to be sub 8s if you're going for a quality grade A asset. And therefore, one would imagine that you will see a successful listing of the third REIT and perhaps growth in the times to come. One would imagine close to 300 million square feet, roughly, of grade A asset would get listed if things go well, as that we've seen so far. A quick look at residential markets. So this graph on the top indicates the quarter by quarter, starting from Q1 19, new launches to absorption and kind of inventory overhang. And you will see the last two bars on the right, complete drop, and the overhang remaining still 28, 31. I think most of the developers are busy selling ready to move inventory. And that's good because no GST, a lot of comfort to the buyers and end users. And I see the first 2 quarters, which were really a wash, I would say, with the exception of South, where Bangalore, Chennai, and even Kochi, where we have a project, we continue to see traction. But West and North was really hit badly. I think after the series of measures announced, moratorium announced, reduction in interest rates, and of course, passing of it by the banks, the overall insecurity amongst end users that some of them were in rented houses and they actually did suffer some kind of issues in dealing with the societies. And even if they did not, they actually felt that it's better to have a home. Then we also saw a lot of non-resident Indians returning to India, and therefore they could afford buying a unit because they had never bought one for themselves, perhaps. And we saw a lot of that traction leading to we exceeding our targets. So if that momentum continues, I believe that we would be able to make up for the first 2 quarters losses substantially, if not 100%. So I'm generally an optimist, and I believe if we do not lead to an unwanted, desirable wave of COVID and everything else unlocking and we keeping mortality rates down, you will see this trajectory to continue even after this festive season. So residential sales are dependent on festive season, so they're doing well, but will they be able to sustain is a concern. So I believe if everything goes right, it would. Otherwise, it may suffer a setback. So this is a quick, it's a busy slide. So let's start from the left. It's done by prop equity. So on the left-hand side, various markets and peak year of these markets on the first column, and then units in the peak year sold and units sold in 2019. So it's very simple. Most of this is a declining trend, and so have the number of new launches. And you saw in the slide earlier, clearly many developers are just not launching enough. And the ones who did launch affordable perhaps are better off than the ones who did not. So clearly this would help when the markets return and the absorption is high and the sales kind of pick up to pre-COVID levels, or at least that momentum, you will see the inventory gap will come down. And I would say relevant inventory gap would be down even more because end users would stay where the infrastructure is good and not go in futuristic locations. So this is a long-term repercussions on customer behavior, in our opinion. So a lot of comfort to the tenants and end users. Most of us are gravitating towards a kind of a caring behavior. The residents are also keen. The buyers are keen. Whether developers have certain credibility, whether the commercial developers also kind of demonstrate that behavior. For example, sharing of CAM charges in commercial, which most of the developers actually demonstrated, was very well appreciated across. And then the third aspect was the digitization. Like I said, most of us developers have actually responded to the digital space very well, whether they are residential buyers, giving them virtual experiences, or commercial properties where you have very sophisticated occupiers already quite aware of technology tools, etc. This is a slide which kind of showcases how the consolidation is taking place amongst the developers. So clearly that was expected and is happening. And I think that got accelerated during NBFC crisis, although capital markets have improved and NBFCs are back in lending, but not with the same momentum as we saw pre-COVID times, or perhaps even a year earlier. But one would imagine that this would actually be a blessing in disguise. I think this was something which was needed. And I think this current situation has already made this a reality. Although this may actually hurt many players in the market, but I think eventually consolidation would bring a lot of discipline with the players who have, clearly the commitments to follow RERA norms and be more compliant and disciplined in their business model. I think the midterm outlook would be, in my opinion, positive. FICCI and Knight Frank came out with Naretco sentiment survey, and you will see the line on the upper graph moving upwards, indicating that the next 6 to 12 months, most of us actually believe that there is a positive sentiment trajectory. So I'm going to move on very quickly. Some bottlenecks which we know have actually disrupted yet made Indian real estate market very transparent, but a lot of scope for refining each of these areas, and the industry has been putting their demands. I think the government is listening and is responding very well. So the central government, a lot of traction, a lot of help needed at the state level, which somehow is still missing. Few more segments, logistic and warehousing. I think I will not spend too much time on this. Extremely encouraging. It has given developers another alternate asset class for them to focus on. They were concentrating too much on residential and commercial. And clearly, the current macro factors and global supply dynamics, I believe there is a lot of traction and therefore is likely to continue to increase. Similarly, data centers, which we discussed earlier, a lot of growth in the last few years, a lot of focus in Mumbai, Bangalore, Chennai, and other markets. I think close to 1,000 megawatts has been announced between 3 or 4 major players, and I wouldn't be surprised if that much more gets committed in the times to come. So with that, thank you very much for your time. I'm sorry if I've taken too much, Nimish. I would like to hand it over to you.
Thanks a lot, Sanjay. And I think hearing Mrs. Sitaraman today in the newspapers, wherein she's saying that we are actually looking at a break-even situation, a net 0-0, not a contraction in the industry GDP growth. I think real estate industry has some contribution to it, the way it looks like. So with that, I would now like to call upon Mr. Ramesh Nair FRICS, CEO and Country Head India JLL and member South Asia Board RICS, to share his insights on the market through his special address.
Thanks, Nimish. I thought we could get into the panel if the panelists can join, and I would give some of those insights during the panel discussion. Thank you everyone for joining today. Let me introduce our panelists for the day. We have Ashish Singh, partner Actis. We have Bhavesh, who is Senior Vice President and Head of Business Development in Tata Realty. We have Chan Chakravarti, MD of Ivanhoe Cambridge. We have Dev Santani, MD of Brookfield. Thank you all for taking the time out today from your busy schedules. Let's hope to get some good insights from our panelists today. The panel discussion is breaking the real estate investment dilemma. All the panelists here are investment experts. So let me start with the first question, Chan, with you. Chan, have we started seeing any green shoots? I know April and May were very terrible months. It is all gloom and doom till around June. But have we started seeing any green shoots in the Indian real estate since then?
I'm going to open with a facetious statement. I think that question should be posed to Dev Santani, because they are the guys who are buying India. So, but on a more serious note, I think, look, I'm going to choose my words very carefully because the idea is not to be negative, but equally, as I say in the sessions that I participate in, I think it's too early to call victory. I think we're in the middle of a dogfight with an element that we have no clue what it's all about. I think a lot of suppositions, assumptions are being made on the basis of media statements, third-party statements about some sort of vaccine, double dose, single dose, Russian vaccine, Chinese vaccine. Frankly, the point I'm trying to make is there are a lot of unknowns. And as an investor, I think, as I'm sure my co-panelists will agree, we're paid to be cynics. And we have to look at downside before we look at the upside. Because I think, first of all, and I'll come back to India and the green shoot question. I think Indian real estate has flattered to deceive a few times over the last 15 years since foreign investors were allowed to come in. I think the recent REIT listings are good tidings. the fact that investors actually, early investors actually were able to see the proof of concept of an exit, or what we would typically say at investment underwriting, that my exit is going to come through a REIT, and that actually happened. So I think that's good. The fact that new cross-border investors came in was also very encouraging. However, I think as we've seen in the Chinese real estate market, I know that's a little bit of a bad word to use these days, but just to be objective, I think what we've seen there is as soon as domestic investors start coming in, domestic institutional investors, that's when you can really say this is a market that has depth. I think India is getting there. It's very encouraging to note that the market is formalizing. Commitments like the one that Dev's firm has made recently, or indeed other peer group investors are projected to be making, I think is very encouraging. It signals that there is still juice left in the marketplace, and I'm talking about the office market for the moment. I'm not talking about for sale residential. That's a different subject matter altogether. But uh, to close green shoots, I think is too early. The market is the jury is still out. I would say let's watch for another 2 quarters before we make that assessment.
Thanks, Chan. Dev, you want to add to that?
Yes, what I'd say, Ramesh, is if you split this up between the office segment and resi, for office, I think our takeaway is definitely that the sector has been fairly resilient in our experience, and all the portfolio that we've hold, what we are seeing from the existing tenants, what we are seeing in terms of new leasing inquiries, and just occupancies across our buildings, I think for us, the takeaway has been encouraging. Now, that may not hold true necessarily for every market and across the board, because there will be an impact on leasing and tenancies, especially for mid-market companies. But the general takeaway, at least, is that on the large tenants, and especially on financial services and the large tech tenants, it's not had a huge impact on either people not paying up or leasing not vanishing overnight. So it's proved to be more resilient than we thought. And in fact, across the board globally in Brookfield, the message has been like, we need to get back to work. Work from home isn't really working. And every office in the world is actually operational. And as landlords, frankly, that's the statement we are trying to make, that every one of our offices across the world is working. People are back to work. And I think people, after the initial enthusiasm on work from home, are realizing that you do need an office, you need to interact, and that's how work gets done. So I think that segment from an India commercial perspective is still relatively steady. On resi, I would say in our portfolio on apartment and condo sales, most of our investee projects are at about 70% odd on an average of pre-COVID sale numbers last month. So that's, I would say, encouraging initially. Now it's difficult to say if this is just coming from pent-up demand, because everything was just shut for like 3 or 4 months. So it's difficult to say if this is just pent-up demand or this trend is going to continue. But the last like 30-60 days, we are pretty encouraged that we are back to 70-80% of pre-COVID sale numbers in most of our projects.
Thanks, Dev. Bhavesh, your thoughts on green shoots? You're on mute, Bhavesh. You have to unmute.
I think that is still too early to say that, actually, as I agree with Chan and Dave on that. It's going to take some time, actually. And, green shoots, as we speak, everybody brings it up to 2019 numbers, and that was the peak, actually. So that's another challenge, actually. Whereas in the residential market, it was on the way down. So it's easier to compare it. But from a peak and then a straight immediately after that, a COVID, it's very difficult to say. But a 20-25 million number, square feet number, which Sanjay said, is a reasonable number if you think about it. And you compare it with 2009, 8-9 global financial crisis. So from that perspective, a 50% number of a peak is a decent number, even from a COVID. So from that perspective, you could say it's a green shoot, but compared to 2019, I would say it's a challenging number, actually, from the peak.
Ashish, you want to add to that? Green shoots?
Well, I think most of it is covered already. I just think that we don't yet know the extent of damage. We are still in an uncertain period. So my sense is that though in the longer run, there are the sort of necessary conditions that are building up for a recovery in many of the sectors. Some sectors are already doing well. I would still say that the rest of 2020 and most of 2021, if not all of 2021, one needs to be cautious and one needs to watch what's happening. I think COVID is not the only thing that is affecting the real estate sector in India. There are some things that were pre-existing. The financing market has been quite challenging, and most of the consolidation that Sanjay Dutt earlier in his presentation referred to has happened because of the trigger that happened due to financing conditions. So one has to be mindful of that.
Ashish, let me start the next question with you. Where do you see, which asset classes do you see more investment and financing coming to? Right now, to buy ready core assets, we have a number of buyers or bidders. But otherwise, residential, even construction finance has become tough of late. Which asset class do you see doing well on the financing side?
Well, I think the traditional sectors continue to struggle at this moment with respect to financing, whether for construction or otherwise. And financing is available only to top tier of sponsors, really. And like I said, consolidation has to do with that. It owes itself mostly to that fact. And so whether residential continues to struggle, mostly from financing perspective. And if you, as you know already, last many years, NBFCs had come in to fill up the gap that was created in financing by the banks. And private sector banks have thereafter run up their own cautious stance. So what's happening now is NBFCs have withdrawn, banks, PSU banks remain largely withdrawn. Of course, there's top tier of developers who has access to credit, but largely credit availability is down. And what needs to happen is private capital needs to come in and fill that gap. But for that to happen, the returns have to stack up, the risk has to stack up. And that is one opportunity that is there for private capital, for example. In offices also, you know, while buying built up offices, operating offices, that remains an area of interest to most investors. We've seen some very recent deals, including one that was done by Brookfield. There's also a big opportunity in build to core. My belief is that what we're building now, what we're designing and building now, is much more advanced than what was designed and built 10, 15 years ago. And there will be a lot of migration of tenants to quality. It will be triggered by a renewed need for employee health and safety standards and well-being, but it will take much movement, proportion of a much larger movement over time. So there is an opportunity to build to core, to do build to core in that. Then there is emerging opportunities. There is already a lot of interest in industrial and warehousing, where also I believe obsolescence is going to lead to its own set of demand apart from new demand. And then you have data centers where technology is really at the forefront of driving it. Digitization is at the forefront of driving it. And like most things, the only thing that is true about technology-driven things is people have underestimated the force with which that technological change happens or scale up happens. So perhaps data center would scale up a lot more than people think today. And then, you know, as and when some structural issues get addressed in the residential sector, you could have other opportunities, you know, rental homes and stuff like that. That also remains a very scalable proposition potential.
Thanks, Ashish. Chan, you want to take that? Which asset class are you most bullish from a capital allocation point of view?
So as far as India is concerned, I think our high conviction themes remain logistics at the top of the heap, and office. For sale residential is a broken model, frankly, according to us, and it's an arguable proposition, and we can talk about that later. But as far as logistics is concerned, whilst one can sit here and talk about all the challenges, and there are, believe me, there are lots of them. But I think the very fact that, and this has nothing to do with COVID, or maybe COVID has just validated it. India is absolutely entering a digital super cycle. There is no question. I think one has to look at what happened in China with the birth of Alibaba, Tencent, etc. I think we're seeing the same phenomena out here. The pace of digitization has shocked everyone in a positive manner. And I think given the very low per capita stock, we are at something like 0.007 per capita, whereas Australia is at about 1.6. China is at about 0.7. China, South Korea. So I think there's basically no stock of any consequence. So I think if most of it is all obsolete stuff. You could just say the Northlight sheds posing. I mean, the new generation in the last 2 or 3 years. Yes, but beyond that, I think it's all obsolete. So I think that's a massive opportunity because of the constrained supply. I think acquisition of land, less said the better in India. But having said that, having been through 2 cycles in this market, I would say there's a marked positive difference. You got to watch out for the pitfalls, but any place that you want to acquire 50 plus acres, I think you're going to face challenges. As long as you have your eyes wide open, I think it's an opportunity worth considering. Office, I think, like I said upfront, let's not talk about last year's peak. That was great. I think just what excites us or gets us encouraged about India office now is that it's moved up the value spectrum. It's no longer your sweatshop BPO kind of activity where cost arbitrage is the only reason you would come to India. I think the very fact that there are core functions that are being transported to India. I mean, you only have to see what the kind of work that Goldman and JP Morgan and the likes, the Wall Street banks are doing in India. I think the fact is that India is now acquiring the reputation of being an innovation hub. And this is not, a jargon. It's real truth. Having been part of a financial institution, I know the kind of activities that are being done out of India: global cash management systems, equity research. So these are not easily transferable to another jurisdiction. I think the other fact is that whilst COVID has opened up a lot of structural elements in terms of the future of office, I can tell you in North America there are huge questions around the future of office and what office should look like. I saw the Brookfield report that came out, and I thought that was a very good articulation of why offices will remain relevant. We think that is one of the things that continues to be attractive in India. In the medium term, I think year 2021, 22, we need to watch out for tenants seeking renegotiations. Let's not paint this all rosy. I think there are going to be challenges. There are going to be bumps along the way. Ashish talked about obsolescence. Ashish talked about new technology, new product. I think that's all exciting. India is formalizing as a market. We see that as a good omen. Having said that, I think built to core, having done it a few times, India, everything takes longer than longer, and it's not because of lack of good intent. It's beyond beyond the asset owner or sponsor's control, that things can go awry. As long as you're not, deploying capital that is limited life and needs an exit in, let's say, 3 or 5 years time, and you have the ability to stay a 10-year cycle, I think it's a good bet to make even now. But otherwise, I would dial down on the risk and go down the risk spectrum to maybe value add or maybe even core plus.
Thanks, Chan. Dave, your thoughts?
Yeah, so in terms of capital allocation, I think the natural gravitation is towards yield assets. So a lot of capital will continue to flow towards office. It's debatable that if you are a new player, if you're going to make money, and there aren't that many quality assets to go around because a lot of large assets have already been snapped up in terms of platforms. And B, the existing players, for example, we have like a massive operating platform, right, to manage some of these. Now, if you come in as a fresh player from outside to allocate capital to office today, to India, I think it will be a tough strategy to execute. But nevertheless, because of the risk levels involved, people will still gravitate towards that from a capital perspective. I think from a size perspective, there is a huge opportunity around stressed assets, whether it's residential, whether you buy out NBFC loans, either side of the action. It's not an easy strategy to execute, but from a value perspective, it's huge, and something has to give. The way the whole financing and the resi sector is lined up, like right, NBFC loans itself are close to 44 billion to the sector. 6 or 8% of this is officially an NPA. And we all understand that there's a lot more NPA than 6-8% in that $44 billion book. So the numbers there are huge. There has to be a private capital solution to sort all this mess out. It's very difficult to say how some of that will happen, of course, but because the whole sector is actually transitioning now, right? And all of this capital gone into projects which are stalled or slowed down, etc., will have to be rescued or revived in some form. So there will be allocation there eventually as yields move up and special sits player move in. So from a size perspective, it's big, but how that will play out is it's interesting for everybody to see.
Bhavesh? Mute, Bhavesh. You'll have to unmute. Still mute.
Okay, logistics is going to play a great role actually in India, especially because of the geopolitical situation and the relationships which will really pan out well in the future. However, the only factor I would like to say about logistics is that it is still a very cheap asset kind of thing. It's like a 50-cent rent kind of thing. Whereas our commercial office space is also like a dollar rent. Like the same logistics space in an advanced country is like $1.5 to $2. And that's the logistics or industrial space. And the office commercial space is much larger actually. So, both these factors, I'm not saying that we are a cheap country kind of thing from that perspective, or it is because of the cheapness that we work. But actually, as Chan said, that is the scalability of the workforce and all that. It's raised to the next level, and that's going to increase. So from a quantum perspective, it's going to always be the office sector. But from a size perspective, actually, commercial, the logistics and warehouse is going to do well. The challenge in the logistic and warehouse is the extensive land parcels which you require, and aggregating of land is a big, big challenge. And the next thing that happens is that the cities in India grow so fast that that logistics area becomes a residential area going forward. And something to that effect actually happens, actually. So, it's a vicious circle. It's going to become like that. You start with a logistics space and then you develop it for 10, 15 years. The city grows. That becomes a residential or a commercial space down the line, actually. And so on and so forth, actually, kind of thing. So looking at that from that angle, logistics and definitely commercial space. Data centers, yes, but it is very restrictive. You need massive sizes. But I think the technology is creating a change in that you need lesser and lesser space today because the equipments are becoming much more efficient of processing and storing more data, actually, kind of thing in data centers. And lastly, but not the least, the residential space will continue in a different way, that it's going to become more relevant space. And I think post-COVID people are looking at more more like Mumbai and all these cities have become very congested, but whether that change is going to happen and people are going to look towards that change and in more less denser areas. So whether that is going to work out, and you're going to have like Mumbai as like 4 or 5 mini cities, Bangalore as 4 or 5, and that kind of thing is going to work out in future in the metropolitan regions, actually, kind of thing.
Dave, let me ask the next question to you. RICS has always been in the forefront of advocacy of various challenges faced by the industry. And today, we all know that financing is the biggest problem in the industry today. What would that one recommendation you would give the government of India if they need to fix this financing challenge right now in the sector?
Look, I think my honest answer is I don't think you can do much on the regulatory side to fix the financing problem. I know people have been going and asking for rollovers, 1 year, 2 year, but that's never been a successful model historically. What you really need to do to unwind this whole mess is find a way to push up demand, right? Eventually the way out of this mess is if demand picks up and sales happen, which funds your construction and which funds your ability to pay the loan back. And from a regulatory perspective, what they really could do is reduce costs all along the spectrum. I mean, developers have been asking for that for ages, so it's not something new. But whether, for example, stamp duty in Bombay, like the moment that period started, our projects in Bombay, like the ones we've invested in, we've seen almost 2.5 times sales post that on a month-on-month basis. And when we talk to customers, it's not that the sentiments has changed or they're suddenly very confident about economic certainty. It's all coming from the push that the stamp duty effect is only for a quarter. Similarly, like premiums reduction or ready reckoner rates, which just keep like flat or going up. Some areas they are crazy. All of that to reduce the cost of the business will really help them to cut pricing, and it's the pricing cut or the efficiency which you pass on to the customer which will really push up demand. I mean, that's the only logical way to unravel out of this problem. Trying to give them rollovers, in most projects the equity is actually zero with the developer. So just forcing the institution to roll over for a year won't really help us solve the problem. It just window dresses the problem for 12 months.
Chan, one suggestion for the government.
So, Ramesh, recently I had the opportunity to interact with the finance and the housing ministry officials. There were two things I said to them. I said, you need to have a very well-articulated policy on completed inventory, where there seem to be barriers for foreign investors. I think, if I'm not mistaken, Dave was also on that panel, or one of your colleagues. And I think, point being, often some of these, adversarial conditions can create a pivot for another asset class. Multifamily, for example, on the rental housing. I know the housing ministry has been very passionate about affordable rental housing. The point is, if this can be, democratized across the entire sector, I think the whole for sale residential marketplace needs a reinvention. Frankly, I think the way the capital stacks are structured are not sustainable. Whether and demand picking up, I think it takes time. It's not going to happen overnight. Therefore, in a declining interest rate environment, where returns were not stacking up on a NOI basis, now if there is a situation where portfolio of completed inventory can be traded, who knows, that could be another opportunity for foreign investors to come in and deploy capital lower down in the risk spectrum and create a new business or asset class by itself. I think that is one suggestion. Otherwise, I think honestly speaking, the federal government has been pretty responsive. I mean, as a pension plan, I have no reason to complain. They've just allowed us a capital gains exemption for warehousing, for example. So I think they've been extremely receptive to suggestions. They're actually reaching out, asking for suggestions on how things can be unlocked to allow more capital to come in. I think on the residential side, this was one of the suggestions that we made. We also suggested that things like data centers or which is basically again falling under the ambit of infrastructure, should also potentially receive similar potential tax exemptions. Life sciences is another area, the whole healthcare infrastructure. I think those are the elements that we have suggested. Now, how much of that is entirely possible, I don't know. As far as stamp duty or any kind of levies that are levied by state governments, I think we need to have very low expectations. We mustn't forget that these state governments are running absolute bankrupt, near bankrupt public finance coffers. So to expect that they are going to, allow their perhaps one of the few sources of revenue left after GST came in, I think is foolhardy. So hence, like Dave said, real demand has to come back. And the final point I would make for sale residential, I know it's digressing, but it's relevant. I think the project level returns are unsustainable at 20+%. I think that is the crux of the problem as far as the for sale residential segment is concerned. Project level returns are no more than 14-15%. It's being hyped up, it's being bumped up to account for promotes, to account for fees, expenses, and it's just not sustainable. And I think that's something that all stakeholders in the entire for sale residential segment need to acknowledge and find solutions accordingly.
Ashish?
Yeah. So my view on financing market is that we are in the middle of a big paradigm change in the market. For a very long time, banks were lending as senior financing, and they were taking mezzanine or equity type risk. They were pricing their capital very low, and they were taking unduly more risk than they set out to take. Thereafter, NBFCs came in, and a testimony to that is that there was more than 1,000 basis points difference between what the equity investors expected in return and what the senior debt lending was going on at. And then came the NBFCs. Because this gap was very wide, NBFCs saw a big opportunity in that, and they came in and they started lending. Where NBFCs went wrong is that they assumed two things wrong. Number one, they did not appreciate as much as they should have the illiquid nature of real estate, especially in the residential. So the cyclical nature of cash flows, there's a certain bit of unpredictability, et cetera, et cetera. And they did not have real estate expertise necessarily on the table in appraising that credit. And the second thing that they did wrong was they used short-term liabilities to finance a lot of long-term exposures. And because of that, we've been in the challenging financing market that we have been in over the last 2-3 years' time. But this is really what's going on is a real cleansing. I think that developers, there are now much fewer developers as a result of this consolidation that has been triggered by the financing market. And those developers that remain must appreciate, and I think they do, the difference between debt and equity. And they will raise equity where they need equity, and they will hopefully raise debt where there's room for debt. And as a result, I think we have to let this happen. It'll take maybe another year or two or so on and so forth, but it's a very good thing for the market to go through this. As far as government, what the government can do is concerned, I consider most of the things that are in the nature of temporary fixes or incentives, that is discretionary on the government, and that they will do depending on their financial condition, their fiscal condition, and et cetera, and so on and so forth. But there are three things that the government can do. The first is, in terms of ease of doing business, they should make the approval timeframes predictable. I'm saying not necessarily compress the approval timeframes, though I do believe that there is significant room for compressing the timeframes for approval. So predictable timeframes for approval is the first thing. The second thing that the government can do is it can improve the perception about policy stability with respect to taxes, etc., etc. So who gets taxed, what, and how, etc., etc., especially with respect to foreign capital. And the third thing is for foreign capital, for global capital, since we are competing with rest of the global economies for foreign capital, having a stable currency goes a very long way. And I think that this government has been doing a fair amount of good job on that. I think our currency has been much more stable than we'd seen some time earlier. And the volatility is much less. And I think these three things, everything else, whether pricing of capital is right or not, I think it's a demand and supply function, and we should let it be. If the pricing is too high, then more supply of capital will come in. If the pricing is too low, then maybe some capital will get crowded out. So I think that this is what the government can do, really.
Chan, you wanted to say something after that. Dev, you also wanted to add. Chan?
No, I just wanted to comment on Ashish's observation that developers, are now realizing the value of equity. I mean, I actually question it, whether they actually do. I think it's more about, I need capital, just give it to me. I'll think about what to call it on a later date. That's all I wanted to say.
Dev?
I had a very quick comment that if you see the 2-3 points which all of us made between Ashish, Chan, and me, right? One, approval costs need to be rationalized, time frame predictable. We need FDI in completed housing. For me, like, state government costs need to come down. If you went back 10 years and did a seminar check of 2010, the same 3-4 points, and I'm sure of whatever Bhavesh is going to add, we would have been there exactly in 2010 also. And it's unfortunate that the same things have been lingering around, but not a lot of those have actually been implemented.
Understood. Bhavesh, let me ask you the next question. There are new asset classes emerging. We touched upon data centers a little bit. There is co-living. There is Chan spoke a little bit about rental housing. Student housing is a very established asset class in some Western economies. Senior living, again, is an established asset class. What are your thoughts around these new asset classes? We all know that the office, retail, residential, hospitality, all that, there's enough interest, especially in office. But these newer asset classes, where do you see financing as well as investment interest? Bhavesh? I think you're on mute, Bhavesh. Still on mute.
Yeah, no, the organizer had muted it. Okay, I agree.
Oh.
Just on the previous question, I completely agree, as they said, on all these points, and fully agree with Chan, Ashish, and they that these are the points which. However, I just wanted to add to Dev's point that the stock of completed inventory in residential is very high now, and that is in a position which institutional investors especially would be keen about it right now. And Ashish's point that the rupee stable makes more sense post the negative interest rate environment abroad. So that helps India from that perspective. And lastly, on the financing part, I feel we need a Freddie Mac or a Fannie Mae so that the banks are released of all these kind of capital requirements, because of the completed assets can go into debt and therefore release the capital to banks, and therefore that would be definitely available to real estate in that sense of it, which these kind of institutions have to be held by RBI. So that would be a key transformation change for capital to flow into this, besides foreign capital required in India. We really require a lot of capital, and whether it comes from or it comes from foreign institutional investors. Coming to different classes of assets, I think student housing is something which we really need. Actually, it's already there because of the structure of the universities and the student accommodation which has been done in India, because these are in far off locations. But if that asset class were to be monetized into REIT structures or acquired, because currently it is restricted because of the nature of the business, which the government is restricting that education has to be under a certain, how do I say, approved institutions only can do it, or charitable institutions or organizations can do it. So therefore, that is the challenge part of it. But if that money were to be released, actually that much more institutions could be created from an education perspective, and that is actually really beneficial to us. And the same thing would apply to hospitals or even to hotel sectors and such other things. The REIT structure definitely would help all of these asset classes. Co-living is something I feel is going to work better, especially if it is a work from home culture is going to come in existing. It is already there now. And if it enhances, what's going to happen is that in offices, you need the training and all that to be done. But if he's going to come one day to the training, then he does not have a mentorship. But then he would like to live in a community which is much more tech savvy, and there he could get some mentorship. And therefore, the co-living structures would work much better, especially in the 6 largest cities, in the locations in which all these office space is available from tech companies. So whether it is R&D or something like that, but that actually helps the workforce and helps India's, to prove itself, which it has already proven in COVID, that it was able to service all its requirements to all its international clients out of India. And we had our services exports which exceeded last year in the first 6 months. So that's a proving point, actually, that we did very well on the office segment, despite we work from home. But that, as everybody says, that people who already trained, so therefore they did it. But going in future, I think co-living will really add to it, actually, in all these 3 sectors. Besides education, as I said, student accommodation is a big thing abroad in UK, US, and Australia, and REITs have been created. And actually, I think India would be the next one if they allow it for institutions to acquire student accommodation.
Thanks, Bhavesh. Dave, your thoughts around emerging asset classes?
So look, I mean, all of these are big asset classes in other countries, right? Especially student housing and multifamily are big asset classes. We have very, very small size of this playing out in the country today. So as an opportunity, absolutely it's there. But I think it's so nascent at this point. It's not really at a stage and a scale where a large foreign investor can come in and make it work out.
Chan?
That's a short answer.
Thanks, Dave.
Yeah, I think Dave is absolutely correct. This is more appropriate for venture capital and private equity because most of it is all aggregated. And then there is, the model that Bhavesh referred to has its own challenges because a lot of these universities are owned by politicians. So, for institutional capital to come in and participate with some of these is very challenging. So I think for a variety of those reasons, and I think the lack of scale. I mean, the fact is, if you want to have really meaningful foreign capital come in, whilst they may be large in other countries in the developed markets, I think unless and until there is some element of scale, which is likely to take at least 3-4 years, I think it's I would focus on the tried and tested evils.
Great. We can take some. We have some time for audience questions. So I'm getting some audience questions here. Let me just kind of. First question, maybe Dave, you can take it. During these times, how do you do due diligence? Also, it's interesting to know what are the parameters while assessing partnership risk. So 2 questions. Maybe Chan can take the partnership risk question, and Dave can take the due diligence question, especially in a COVID environment of working from home, and except Dave, who's working out of Dubai. Given the COVID situation in India. So Dave, over to you.
No, so it's hugely challenging. So while I have this nice background behind me today, the largest transaction pretty much I've worked on, I spent 6 months from March to September sitting in Mumbai at my house doing the diligence. And this was a conglomerate financing. It's in the press and stuff. So, it goes, the name is not required. But it's usually challenging to actually do a diligence exercise spread across, 10, 15 members, people sitting in New York, your diligence advisor is sitting somewhere else, the company can't access documents. It is challenging, but I think the positive message is what we discovered is we could do it, and we literally for this group diligence close to 15 operating businesses. All of it, each one of them was somewhere between a 500 million to $1 billion top line. So these were all real operating businesses where we did full-fledged legal financial diligence. So it's possible. Um, it means lots of long hours and a lot of conference calls and Zoom, so you develop back problems, but it's possible. The challenge I would say is more when we are doing these transactions on underwriting today as an institution, because to say coming out of COVID, what are your future projections for the next 6 months, 12 months, 24 months, how some of these sectors will crawl back to normalcy, what's going to be the economic impact of COVID on some of these sectors, that I would say is a much bigger challenge, because DD is logistical challenges. I think there are like strategic challenges to some of the stuff going on.
Chan, the promoters, what would you look at in a partner?
Well, I think track record, number one. Actually, why number one? I think track record is one of those. I think reputationally, do they walk the talk? I think more than current reputation, their ability to walk the talk and institutionalize themselves to the levels that we would expect them to. I think those are the two aspects that we focus on, frankly. That is the primary risk, especially in our model, where in markets like India, we wouldn't work on direct deals ourselves. So partner risk is something we take very, very seriously, and we still get it wrong.
Audience, you could type in your questions in your chat window. If you have any questions. There's a question on student housing zoning of land. Can anyone answer this? Which zoning would student housing come under? Will it come under residential or commercial? Anyone wants to give it a try? I know it'll vary from state to state, city to city.
My understanding is it falls under industrial, more like hotels.
More like hotels, okay. So as we wait for some of the audience questions, it's been a little limited today. I'll try and summarize. Okay, this is one interesting question. US election result. Dave and Chan both are Canadian. US election result on Indian real estate. Is there an impact? Or want to give it a try? Any of you?
Go for it, Dave.
This is one of the ones I was planning to push off to Chan. But no, I mean, look, I think for long-term views on the country and long-term institutional investors, politics comes and goes. Of course, if something crazy happens on the political side, your view on the country changes. But this is the other way around, right? Right now, the crazy is being in place. So either way, whatever side shows up, I don't think it changes what we are doing in India.
Doesn't impact. Chan, your thoughts?
Yeah, absolutely. I think no impact. I mean, if we had to expect an impact, it was the first time around. I don't think that happened. So yeah.
Standardization of building efficiencies. I know RICS has been trying this, getting at least the efficiencies, a super built up area to carpet area in an office building forever. I remember 2008 onwards, we've been talking about it, but still every building in the country has its own efficiency definitions. And how do we get it done? Bhavesh, you want to give it a shot? Bhavesh, Ashish?
I think it's a very difficult one. Actually, I think it is linked with the approval laws of each of the cities and actually all the plans. If you think in Mumbai, you had all this car park, FSI, and all that. So see, these are the factors. Sometimes they give staircases free or balconies were free, and actually that is impacting it more than this. It's more of the municipal laws which are impacting you in differing efficiencies. It has nothing to do with FRICS will take it up. Actually, however, post that, if the FRICS would like to take it up, then it should be more on a specific basis, because commercial office, whether you talk of an IT park or a commercial building, is more or less the same, actually, kind of thing. It's only the law a little bit, actually. So effectively, it could be done, but it is very challenging in different cities and because of the municipal laws, actually.
I think with the top 20-25 developers controlling nearly 400 of the 600 million square feet, I think if the top 20-25 developers themselves come together and have one definition, I think that could help too. Ashish, there's a question.
Can I add something?
Yeah.
Then I would
just,
say
just
that
one.
Actually, there's a lot of other questions also. I'll just ask you one other question. Ashish, what do you think of tier 2 cities? That's a couple of audience have asked that question. Tier 2 cities, future.
So for different businesses, the answer could be different, in my opinion. For business to business, for those segments of property which have business to business kind of selling, they are more driven by urban job creation. They are more driven by where the talent is, for example, office and some of the other sectors. So, for example, for residential and retail, yeah, there would be an opportunity in tier 2 cities. But for offices, no scale up has happened in tier 2 cities. And that's mainly because most of the talent wanted to concentrate in more urban tier 1 cities where the opportunities are better, lifestyle is better. So I would say that, and for warehousing, really, tier 2 cities are really the new opportunity. Tier 1 city is more replacement opportunity. So the answer would be different.
Chan, there's an audience question. Your thoughts on co-working industry, the future of co-working industry?
I think it's going to surprise us. I think notwithstanding COVID, given the need for flexibility, especially how businesses are thinking about managing their workforce, I think we're going to be surprised on the positive.
And
as long as they sorry?
And occupiers not wanting to spend capex also. I think that's a big driver again.
Yes, absolutely. It's just flexibility. The whole notion of actually, making sure that you're running a tight ship and able to, come in and go out. But I mean, for it to succeed, of course, these co-working operators have to be well capitalized. I think the fact that Brookfield has bought into one now is very interesting. And I think it needs a lot of financial a strong balance sheet to back it to account for these short-term liabilities like in the NBFCs.
I don't know who can take this question, but it's a very interesting question. What percentage will the construction costs go up because of COVID, because of all the new safety, wellness, health features required for the building? Any idea around this? Can anyone give an answer, or it's too early to?
I think Ramesh, you should be telling us this.
It's about,
I'll definitely do a research and come back on this. It's a very interesting question. Early days though, not too many buildings have started in the last 2-3 months, but very good question. Is China a model of developing a city to bring in people rather than a city which is already there? Will that kind of a model work in India? Anyone wants to give it a shot? Dave, only you can buy a city.
But we have no intention to. No, I think it's challenging in India to replicate that model. It's a different system of governance, obviously, in China, but just the complexities around, I mean, one is the financial requirements, but just the complexities around, land and approvals and urban infrastructure, and to do all of that from scratch in India, even a regular building sometimes takes years and years to complete. Like a million square foot takes, I don't know, 5 years to complete sometimes here, and you see it come overnight in some of the other markets. So I think developing a city we are some distance away from that.
One more question before we wrap up. The future of retail malls in terms of investments. Who wants to take that? Chan, you want to take investments into malls?
Yeah, I can offer a perspective. I think from a house point of view, I think it's a bad word for us, given we have such a large exposure in North America. But I don't agree with it. I mean, I'm a dissenter. I think in a market like India, I think again, just like logistics, the per capita stock is so low, and just the way our whole public spaces are structured, there is still a very strong relevance. Maybe I wouldn't go as far as doing standalone shopping malls, but certainly what I describe as neighborhoods of tomorrow in a mixed-use environment. I think there's a lot of relevance.
Thanks, Sam. With that, we'll wrap up the session. Lots of key takeaways and insights for me. I'll try and summarize some of them. Chan felt it's too early to call victory when I asked about the green shoots. The phrase he used is we're middle of a dogfight. Lots of assumptions being made on vaccines. A lot of unknowns. The good things which are happening, the REIT exits has been a good thing. New FDI investments, new companies coming in, that's a good thing. Office has been resilient. They felt that work from home not really working across the world. Residential, he said, in some markets it's reached 70% of the pre-COVID demand. Most of the panelists felt that including Bhavesh, felt that don't compare with the 2019 numbers. Comparing resi was very low, office was very high. 2021, the panelists felt need to be cautious again. Financing market is challenging. Financing available only to the top 20, top 30 firms. The panelists felt that resi is still a struggle. A lot more private capital required, but risk return expectations not matching. Opportunity is still there in build to core. Obsolescence is something people need to worry. People are quite bullish on the logistics and the office as an asset class going forward. More for sale residential is a broken model in the country, according to Chan. He spoke about the digital super cycle, spoke about how we can learn lessons from Alibaba and Tencent capturing, and that will lead to a lot more warehousing and industrial needs. Office customer has moved up the value chain from the old sweatshops to innovation hubs. That is a good thing to hear. Chan's advice was also in 2021, tenants will renegotiate and landlords need to be prepared for that. Dave spoke about yield assets will see maximum interest. There would also be interest on stressed assets opportunities in residential and NBFCs. Not an easy opportunity, but with a lot of value potential. It was interesting to hear some data points, Dave, from you in terms of 44 billion NBFC loan book. Nearly 8% are NPS, 8% quoted. The real number could be much more. And you need a lot more private capital solutions if you need to solve that. Logistics, the panelists felt has a lot of future, but rental for warehousing and office still is very low. Bhavesh mentioned that, which will impact quantum of investments. The other day I was looking at where the global pool of capital goes to. US number was $475 billion. And India is $5 billion, and even Germany, I think, is 80. Australia is around 40. Great Britain is around 60. So India is still a very, very small part of that global 1 trillion pie. We're just 5 billion of that. Warehousing aggregation of land is still a challenge. more mini cities required within the big cities. We have seen that happening in a few cities. On the government front, they felt OTRs won't work. Government should focus more on driving demand, reducing costs across the spectrum. Stamp duty, he felt, was a very good move by the Maharashtra government. Policy around completed inventory required. Affordable rental housing, a proper policy is again required. Capital gains exemption on warehousing allowed for pension plans. That is a good move by the government. Expecting more state governments to reduce stamp duty is tough, given that there's not much of money they're making these days. At 20%, project level returns are unsustainable. That's something the panelists felt. Consolidation will continue. We need more predictable approval times, more compressed approval times. Policy stability on taxation is what the government needs to give. Stable currency environment again is required. Release more capital to banks. Bhavesh felt that. REITs, if we need to see more alternate asset classes coming, we need more REITs. And work from home, the panelists felt, will help co-living. And they've also felt that emerging asset classes are still very nascent. Chan agreed with that. And it's more of a VC kind of an opportunity. And what are these investors looking for in partners? They're looking for the reputation and the track record of partners. So that is a good, interesting discussion. Lots of good insights. And I hope our audience got to learn a few things. With that, I'll hand it over back to the organizers. Thanks a lot, panelists. The last 1 hour was, I'm sure, was a good investment for the audience. Over to you, Nimish.
Thanks a lot, Ramesh. And I would like to take this opportunity to address the question which was asked on standards, Ramesh, because we are, as RICS, we are working very closely on this. Just to inform everyone over here, IPMS, International Property Measurement Standard, and we had an Indian version of it, which is IS 3861. Well, the earlier IS 3861, which was written by BIS, was something which you could mock at, because that was at complete loggerheads with what RERA was defining as definitions and what CPWD books were defining as definitions. But as you said, and as you know, that most of the central government bodies are now listening to what should be the changes in their systems. They have listened to what is to be done, and they have asked us to remodel the entire IS 3861 on IPMS. It is supposed to be launched, so that contains the residential and commercial part. It works on a component area system. So even if there are complexities within the states, the component area system can work really well, but still brings transparency and standardization to how it should work. So I'm hoping that BIS will be up on it. So it is supposed to be put to the main committee, CED 44. So we are hoping that this will get passed immediately and will become an Indian standard for which we can follow. But thanks a lot, Ramesh, and given and for your summary also, which is always, I mean, it is so lovely. If none of us has listened to the entire presentation or panel discussions, it is always better to look at Ramesh's summary, which is beautiful, succinct, and highlights the all pertinent parts of it. So given the choice of the investment tools available, whatever the financial instrument is, the success of various investment prospects is actually dependent on the extent and ability of it to address complexities associated with the Indian real estate sector. And you guys actually brought that up really well. Through the course of today's deliberations, it was obvious that the opportunities are there. There is a bandwidth for new asset classes as well, but then people have to be professional around it. People have to think through before they can jump into it. I would like to thank all our speakers and panelists for making time to have this extremely intriguing dialogue with us. I would once again like to thank our presenting partner, Intellian by Tata Realty, knowledge partner, JLL India, and a special thanks to Ramesh to make sure that this was a very engaging session for making our leadership forum a success. So with that, ladies and gentlemen, we draw today's presentation to a close. I truly hope you enjoyed the discussions. Take care and look forward to having you join us for our ongoing series of leadership forums. Thank you and good evening, everyone.